In a world where economic power is increasingly measured not just by currency reserves, but by the gleam of precious metals stored in fortified vaults, a quiet yet profound shift is underway. China, the world's second largest economy, has reportedly added an estimated 300 tons of gold to its holdings in 2025 alone, pushing its official reserves beyond 2,300 tons, while unofficial estimates suggest even greater accumulations. This hoarding, part of a broader strategy among BRICS nations, Brazil, Russia, India, China, and South Africa, now expanded to include Egypt, Ethiopia, Iran, Saudi Arabia, and the United Arab Emirates, signals a deliberate move toward financial autonomy. As these countries' combined gold vaults swell to over 6,000 tons, representing nearly half of global central bank holdings, the implications ripple across international markets, challenging the dominance of the US dollar and reshaping the architecture of global trade. To fully appreciate this development, we must start from the basics, assuming no prior knowledge of the intricate roles gold plays in modern economics and geopolitics. Gold has long been more than a mere commodity. It serves as a cornerstone of financial stability for nations. Central banks, the institutions responsible for managing a country's money supply and interest rates, hold gold reserves as a hedge against economic uncertainty. Unlike paper currencies, which can be printed at will and thus devalued through inflation, the gradual rise in prices that erodes purchasing power, gold maintains intrinsic value due to its scarcity and historical role as a medium of exchange. In simple terms, inflation occurs when too much money chases too few goods, often resulting from excessive government spending or loose monetary policy. Gold, being finite, acts as a counterbalance, preserving wealth during crises like wars, recessions, or currency collapses. For emerging powers like those in BRICS, accumulating gold is not just about wealth preservation, it is a strategic tool for de-dollarization, the process of reducing reliance on the US dollar in international transactions. The dollar has dominated global trade since the end of World War II, largely through the Bretton Woods system established in 1944, where currencies were pegged to the dollar, which was convertible to gold at a fixed rate. That link was severed in 1971 when the US abandoned the gold standard, allowing the dollar to float freely, backed primarily by faith in the American economy and its military might. To understand China's recent surge in gold acquisitions, we need to trace the historical context of its economic ascent. China emerged from isolation in the late 1970s under Deng Xiaoping's reforms, transitioning from a centrally planned economy to one incorporating market elements. By the early 2000s, it had become the world's factory, exporting vast quantities of goods and amassing foreign exchange reserves, primarily in US dollars and treasury bonds. These reserves, now exceeding $3 trillion, provide a buffer for imports and currency stability, but expose China to risks like US inflation or geopolitical tensions that could freeze assets, as seen with Russia's experience following its 2022 invasion of Ukraine. In response, China began diversifying into gold around 2009, revealing a jump from 600 tons to over 1,000 tons in a single disclosure. This pattern of intermittent, large announcements continued, with reserves officially reaching 1,948 tons by 2019. The strategy intensified amid US-China trade wars under President Trump, where tariffs, taxes on imported goods, highlighted vulnerabilities in dollar dependency. Stepping through the events leading to 2025, the COVID-19 pandemic in 2020 accelerated global economic fragmentation. Supply chain disruptions and stimulus spending worldwide fueled inflation, prompting central banks to seek safe havens. China resumed public gold purchases in late 2022 after a hiatus, adding about 62 tons that year. In 2023, acquisitions ramped up to 225 tons, driven by rising gold prices and escalating tensions over Taiwan and technology restrictions. By 2024, official additions totaled around 200 tons, but analysts noted discrepancies. Domestic gold production and imports far exceeded reported uses, suggesting unreported stockpiling. Entering 2025, the People's Bank of China (PBOC) maintained this momentum, with official monthly disclosures showing small increments, such as 5 tons in the first quarter, but cumulative estimates from market watchers pointed to far larger volumes. For instance, gold imports via Hong Kong and Shanghai surged, with net inflows exceeding 1,000 tons annually when including recycled metal and jewelry demand. By mid-2025, official reserves stood at approximately 2,298 tons, but independent assessments, factoring in unreported purchases through state-owned enterprises and private channels, suggested additions of up to 118 tons in the third quarter, a 55% increase year-over-year. This pattern culminated in estimates for the full year approaching 300 tons or more, as China capitalized on dips in gold prices amid global volatility. The mechanics of these purchases reveal a methodical approach. The PBOC buys gold on international markets like the London bullion market or through bilateral deals, often in secrecy to avoid price spikes. In November 2025, for example, it added about zero point 0.9 tons officially, pushing totals to 2,305 tons while extending a buying streak that began in November 2024. However, a significant portion occurs off balance sheet. State banks and mining companies acquire gold domestically or from allies like Russia, which sold nearly $1 billion worth, about 20 tons, in a single November transaction, the largest bilateral gold deal on record. This opacity allows China to build reserves without alarming markets, where gold prices hit record highs above $4,400 per ounce in late 2025, up over 40% for the year. Domestically, reforms like value-added tax adjustments on gold trading in November influenced retail demand, but central bank hoarding remained the primary driver. This accumulation is not isolated. It aligns with BRICS' collective strategy. Formed in 2009 as an economic forum, BRICS expanded in 2024 to counter Western-led institutions like the International Monetary Fund (IMF) and World Bank. By 2025, the group's gold reserves exceeded 6,000 tons, controlling about 50% of global central bank holdings. Russia leads with 2,336 tons, bolstered by sanctions evasion and domestic production. India added 39 tons by mid-2025, reaching 880 tons, while Brazil resumed buying with 16 tons in September, totaling 145 tons. South Africa, a major producer, holds steady at around 125 tons. New members contribute modestly. Saudi Arabia with over 300 tons, the UAE with 74 tons, and others like Iran and Egypt adding smaller amounts. In 2025, BRICS nations collectively purchased around 800 tons, valued at over $100 billion, with Russia and China accounting for 74%. This surge reflects a coordinated push for de-dollarization, accelerated by U.S. weaponization of finance through sanctions. Delving into the step-by-step evolution within BRICS, the process began with bilateral trade settlements in local currencies. China and Russia, for instance, conduct over 90% of trade in yuan and rubles, bypassing dollars. By 2023, discussions at BRICS summits in Johannesburg emphasized a common currency or unit of account. In 2024, the group floated the idea of a gold-backed digital token. This materialized in 2025 with the launch of the unit, a settlement mechanism composed of 40% gold and 60% a basket of BRICS currencies, piloted on October 31 by the International Research Institute for Advanced Systems (IRAS). Designed for cross-border payments, the unit reduces transaction costs and dollar exposure, with gold providing stability. By December 2025, initial trials involved commodity trades, such as oil from Saudi Arabia settled in units rather than dollars. Hidden factors underpin this gold rush, often overlooked in mainstream narratives. Geopolitically, China's hoarding counters U.S. dominance in SWIFT, the global payment network from which Russia was partially excluded. By holding more gold, BRICS nations enhance their leverage in institutions like the New Development Bank, established in 2014 to fund infrastructure without Western conditions. Economically, gold serves as insurance against dollar debasement. U.S. debt surpassed $35 trillion in 2025, fueling inflation fears. China's strategy also ties to its Belt and Road Initiative, where gold-backed loans to partners in Africa and Asia build influence. Less discussed is the environmental and social cost. Increased mining in China, including a massive undersea deposit off Shandong discovered in 2025 with over 3,900 tons in reserves, raises sustainability concerns. Moreover, unofficial purchases, estimated at 10 times official figures, allow deniability while amassing power, with China's true reserves potentially nearing 5,000 tons if including private and military holdings. Another underappreciated aspect is the role of technology in gold management. Blockchain platforms for digital gold tokens, piloted in BRICS, enable fractional ownership and faster transfers, blending ancient assets with modern fintech. Psychological factors play in too. Gold's cultural significance in China and India, where it symbolizes prosperity, bolsters public support for accumulation. Politically, this unites disparate BRICS members, authoritarian regimes like China and Russia with democracies like India and Brazil, around a shared anti-hegemonic agenda despite internal tensions over trade imbalances. The global implications of this hoarding extend far beyond BRICS borders, potentially upending the post-war economic order. First, it accelerates de-dollarization, with over 30 nations applying to join BRICS by 2025, drawn by alternatives to dollar-denominated debt. If the unit gains traction, it could divert billions from dollar-based trade, weakening U.S. ability to impose sanctions. Gold prices, already at records, may climb further, benefiting producers like Australia and Canada but hurting importers and jewelers. For developing economies, this offers relief from dollar volatility. African nations, for example, could settle debts in gold-linked units, reducing interest burdens. However, risks abound. Fragmentation could raise transaction costs, slowing global growth. In the West, this prompts policy reevaluation. The US and Europe, holding about 40% of global gold, may increase their own reserves or tight export controls. Inflation in dollar-dependent regions could spike if confidence erodes, as seen in emerging markets during 2025's volatility. Environmentally, heightened mining demands strain resources, contributing to climate challenges. Socially, wealth concentration in vaults exacerbates inequality, as ordinary citizens face higher prices for gold-based savings. As we reflect on this accumulation, it becomes clear that China's addition of an estimated 300 tons in 2025, amid BRICS overflowing vaults, marks a pivotal moment in economic history. What began as prudent diversification has evolved into a bold assertion of multipolarity, where power flows not solely from military might but from fortified reserves of enduring value. Yet this path is fraught with uncertainties. Gold stability depends on market faith, and overreliance could expose vulnerabilities if prices crash or alliances fracture. For the world, it underscores the fragility of unipolar dominance, urging dialogue over division. In the end, as vaults brim with gold, the true measure of power lies in sustainable cooperation, reminding us that wealth hoarded in isolation may shine brightly but casts long shadows on shared prosperity. The landscape of global gold reserves reflects a year of sustained accumulation by central banks, with China continuing its measured yet strategic additions amid record-high prices. The People's Bank of China reported an increase in its official holdings to approximately 2,303 tons by the end of the third quarter, with further modest increments in subsequent months bringing the total close to 2,310 tons or more, depending on the latest disclosures. While official purchases for the full year amounted to around 50 to 60 tons, far below earlier peaks, this steady pace occurred against a backdrop of gold prices exceeding $4,400 per ounce at times, underscoring a commitment to diversification that persists even in elevated markets. BRICS nations collectively bolstered their reserves significantly, acquiring over 660 tons in the first 9 months alone, pushing combined holdings beyond 6,000 tons and reinforcing their position as holders of roughly one-fifth of global central bank gold. This ongoing buildup, coupled with the pilot launch of a gold-linked settlement mechanism known as the unit, marks a deliberate evolution in efforts to reduce vulnerability to dollar-based systems, highlighting the enduring appeal of gold as a neutral asset in an era of geopolitical and financial uncertainty. Throughout 2025, China's approach to gold accumulation demonstrated prudence amid volatility. Official data revealed consistent monthly additions, often in the range of 1 to 5 tons, extending buying streaks into late in the year. For instance, disclosures in the final quarter indicated increments that maintained momentum, even as global prices fluctuated sharply. Analysts noted that imports and domestic flows suggested possible unreported acquisitions, though official figures remained the benchmark, reflecting a strategy of gradual enhancement rather than aggressive surges seen in prior years. This moderation aligned with broader central bank trends, where net purchases slowed from the torrid pace of 2022 to 2024 but remained robust, driven by institutions seeking to elevate gold's share in reserves to levels offering greater insulation against currency risks and inflation. Within the BRICS framework, the year's developments built on established patterns of coordination. Russia's holdings stayed prominent at over 2,300 tons, supported by domestic production and sanctions-driven imperatives. India continued steady additions, reaching nearly 880 tons, while Brazil's resumption of purchases after a hiatus contributed meaningfully. Newer members, including Saudi Arabia and the United Arab Emirates, added to the bloc's depth with their substantial existing reserves. Collectively, these efforts not only expanded physical stockpiles but also underpinned practical initiatives, such as the introduction of the unit, a settlement instrument partially anchored to gold and designed for cross-border transactions among members and partners. Piloted in late 2025, this mechanism represents a tangible step toward facilitating trade in non-dollar denominations, with gold providing a stable reference point amid varying currency values. Less visible but equally significant factors continue to shape these dynamics. The persistence of high prices, driven by investor inflows, tariff uncertainties, and expectations of monetary easing in major economies, tested the resolve of buyers, yet demand from emerging market central banks held firm. Gold's role as a hedge against potential asset freezes or debasement gained renewed salience, informed by past experiences of financial isolation. Environmental considerations around expanded mining, particularly in producer nations, emerged as a counterpoint, though strategic priorities predominated. Technological integrations, such as blockchain elements in new payment prototypes, offered efficiency gains, blending traditional asset security with modern infrastructure. The global ramifications of this year's reserve growth extend across economic and geopolitical spheres. Sustained central bank demand contributed to price resilience, benefiting producers while challenging importers and consumers reliant on gold for cultural or industrial purposes. De-dollarization progressed incrementally, with bilateral settlements in local currencies expanding and alternatives to established networks gaining traction. This fragmentation carries implications for transaction efficiencies and growth prospects in a multipolar environment, where alignments increasingly influence access to finance and markets. For Western institutions, holding substantial gold reserves provided continuity, yet the shifting composition of global holdings signaled evolving balances of influence. In reflecting upon 2025, the accumulation of gold by China and its BRICS partners affirms a long-term orientation toward resilience and autonomy in an interconnected yet contested financial order. Official additions may have tempered compared to prior peaks, but the underlying rationale, diversification, stability, and strategic positioning remained undiminished. As vaults continue to fill and innovative mechanisms take shape, gold reaffirms its timeless function as a bridge between eras of change. The path forward will likely involve balanced adaptations, where the pursuit of independence coexists with the realities of global interdependence, guiding nations toward frameworks that prioritize enduring value over transient dominance. In this evolving narrative, the quiet strength of precious metals endures, offering a foundation for stability amid the complexities of international relations and economics. The global gold market closes a year of extraordinary performance, with prices stabilizing near record levels around $4,480 per ounce after touching highs above $4,500 earlier in the month. Central bank accumulation, while moderated compared to the peaks of prior years, has remained consistent, reflecting a deliberate strategy of diversification amid persistent uncertainties in currency markets and geopolitical alignments. China's official reserves, as reported by the People's Bank of China, have reached approximately 2,305 tons following incremental additions throughout the year, including modest purchases in the final months that extended a prolonged buying streak. This brings the year's reported net additions to around 26 tons, elevating gold's share of China's foreign exchange reserves to over 8%, a meaningful increase from the start of 2025. Across the broader BRICS grouping, collective holdings now exceed 6,000 tons, with contributions from members like Russia at over 2,300 tons, India nearing 880 tons, and others adding to the bloc's substantial position in global reserves. The year's developments in gold demand have been shaped by a confluence of factors, including sustained investor interest in safe haven assets, robust retail buying in key markets, and the strategic imperatives driving official sector purchases. Although the volume of central bank acquisitions slowed from the torrid pace of 2022 to 2024, when annual totals exceeded 1,000 tons, the underlying motivations persisted. Institutions in emerging markets continued to view gold as a reliable store of value, less susceptible to the risks associated with concentrated holdings in any single fiat currency. This prudence was evident in steady, if smaller, monthly increments reported by several banks, even as prices climbed significantly. Within BRICS, the momentum toward alternative financial mechanisms gained practical expression through the pilot implementation of the unit, a settlement instrument introduced in late 2025. Composed of 40% gold and 60% a basket of member currencies, this digital tool has begun facilitating select cross-border transactions, offering reduced exposure to external payment systems and enhanced efficiency in bilateral trade. Initial applications have focused on commodity flows, demonstrating the feasibility of blending physical asset backing with modern blockchain infrastructure. While still in early stages, this development underscores the bloc's commitment to building resilient frameworks that prioritize stability and sovereignty. Less prominent but noteworthy elements have also influenced the year's trajectory. High prices, while testing affordability for consumer segments like jewelry, did not deter official buyers who often prioritize long-term reserve composition over short-term cost considerations. Domestic production in major nations contributed to supply, yet demand dynamics, bolstered by exchange-traded fund inflows and cultural preferences in Asia, maintained upward pressure. Environmental and regulatory adjustments in mining jurisdictions added layers of complexity, though strategic accumulation proceeded apace. On the international stage, these trends have contributed to ongoing discussions about reserve management and monetary evolution. The resilience of gold demand amid elevated valuations highlights its enduring role as a neutral asset capable of bridging diverse economic systems. For sanction-vulnerable economies, it provides tangible security; for others, a hedge against inflation or debasement risks. The fragmentation of global finance, evident in expanding non-traditional alliances, has amplified gold's appeal as a common denominator less prone to unilateral interference. As we reflect on the close of 2025, China's methodical enhancements to its reserves, alongside parallel efforts within BRICS, affirm a broader realignment toward diversified and robust holdings. Official additions may have been measured, yet they build upon years of consistent policy, gradually elevating gold's prominence in national balance sheets. The emergence of tools like the unit represents incremental progress toward multipolar arrangements, where value is anchored in tangible assets rather than singular currency dominance. Gold's performance this year, marked by record achievements, serves as a testament to its timeless utility in navigating uncertainty. Looking ahead, the interplay of macroeconomic policies, trade dynamics, and institutional behavior will continue to shape outcomes. Sustained central bank interest, even at moderated volumes, provides a foundation of support, while innovative settlement approaches may expand practical applications. In an era of transition, gold remains a steadfast component of strategic planning, offering continuity amid change. This year's chapter reinforces that prudent accumulation, pursued with patience, contributes to long-term stability, encouraging a measured perspective on the evolving contours of global economics and the quiet power residing in fortified reserves. A transformative year for the global gold market, prices have stabilized near historic peaks, with spot gold trading around $4,480 per ounce following brief excursions above $4,500 earlier in the session. This positioning reflects a year of extraordinary gains, over 70% in some measures, driven by persistent safe haven demand, monetary policy shifts, and structural buying from central banks. China's official reserves, as disclosed by the People's Bank of China, have reached approximately 2,305 tons through consistent, though moderated, additions in the latter months, including increments that extended buying activity into the final quarter. Year-to-date reported purchases stand at around 26 to 44 tons depending on reporting variances, elevating gold's proportion of China's foreign exchange reserves to over 8% in recent assessments. Across the expanded BRICS alliance, collective holdings now surpass 6,000 tons, bolstered by contributions from Russia at over 2,300 tons, India nearing 880 tons, Brazil at 145 tons, and inputs from newer members, underscoring a bloc-wide emphasis on tangible asset diversification. The year's trajectory for gold demand has been characterized by resilience in the face of elevated valuations. Central bank acquisitions, while tapering from the unprecedented volumes of prior years, maintained positive momentum, with global net purchases projected at around 850 tons for 2025, still a substantial figure that provides foundational support. Emerging market institutions, in particular, continue to prioritize gold for its role in mitigating currency risks and enhancing reserve stability, even as prices tested buyer resolve. Within China, the pattern of monthly disclosures, often in the range of 1 to 5 tons, reflected a calibrated approach, aligning with broader trends where strategic accumulation outweighed short-term price sensitivity. In the BRICS context, 2025 witnessed notable advancements in collaborative financial infrastructure. The pilot deployment of the unit, a digital settlement instrument partially anchored to gold, progressed through initial trials, incorporating a structure of 40% gold backing alongside a basket of member currencies. IMPL. Minted on blockchain platforms, this mechanism has facilitated targeted cross-border transactions, primarily in commodities, offering reduced dependency on external systems and improved settlement efficiency. Though in nascent stages, its development illustrates the practical application of accumulated reserves, transforming static holdings into active tools for trade autonomy. Underlying factors less highlighted in daily market commentary have sustained this environment. The interplay of geopolitical tensions, fiscal expansion in major economies, and expectations for continued monetary easing created a conducive backdrop for gold's appeal as a neutral hedge. Investor inflows into physically backed funds reached record quarterly levels at times, diversifying beyond traditional central bank drivers. Cultural and retail demand in key Asian markets provided additional ballast, offsetting pressures in segments like jewelry amid high costs. Environmental and supply considerations in mining added nuance, yet did not derail the overarching trend of demand outpacing available flows. Globally, these patterns have deepened reflections on reserve composition and monetary evolution. Sustained elevation in prices, while challenging for certain consumer applications, affirmed gold's function in bridging disparate economic frameworks, offering security to those navigating sanctions or volatility and diversification to broader portfolios. The incremental expansion of alternative settlement options signals gradual shifts in trade alignments, where tangible assets complement digital innovation. As the year concludes on this December day, China's steady enhancements to its vaults, paralleled by BRICS-wide efforts, encapsulate a deliberate pursuit of resilience in an uncertain landscape. Reported additions, though measured against prior benchmarks, contribute to a cumulative repositioning that elevates gold's strategic weight. The ongoing refinement of instruments like the unit points toward pragmatic steps in multipolar finance, where stability derives from diversified anchors rather than singular dependencies. Gold's remarkable journey through 2025, culminating in sustained highs, reaffirms its enduring capacity to adapt across epochs of change. In the periods ahead, the balance of policy directions, trade flows, and institutional preferences will influence trajectories. Continued central bank engagement, even at tempered paces, furnishes underlying strength, while emerging mechanisms may broaden utility. Amid evolving global dynamics, gold persists as a reliable element of prudent strategy, fostering equilibrium in times of transition and underscoring the value of patient, foundational approaches to wealth preservation and international cooperation. This year's developments, viewed in totality, highlight not merely price achievements but the quiet consolidation of structural roles that promise continuity well into the future. The year to a reflective close amid holiday observances and thin trading volumes, the global gold market maintains its position near historic highs, with spot prices holding steady around $4,480 per ounce after earlier peaks above $4,500. This stability follows a year of remarkable appreciation, with gold advancing over 70% in some measures, propelled by a combination of safe haven inflows, central bank demand, and broader shifts in reserve management strategies. China's official gold reserves, as reported by the People's Bank of China, stand at approximately 2,305 tons following incremental additions throughout the year, including modest purchases in the closing months that sustained a prolonged streak of accumulation. Year-to-date official net purchases for China amount to roughly 26 tons, contributing to an increase in gold's share of the nation's foreign exchange reserves to over 8% in recent assessments. Within the expanded BRICS framework, collective holdings exceed 6,000 tons, reflecting ongoing contributions from members such as Russia at over 2,300 tons, India approaching 880 tons, Brazil at 145 tons, and newer participants adding to the group's aggregate depth. The trajectory of gold demand in 2025 has demonstrated notable persistence, even as the pace of central bank acquisitions moderated from the exceptional levels of preceding years. Global net purchases by central banks are estimated to approach 850 tons for the full year, a robust volume that continues to underpin market fundamentals despite elevated prices. Emerging market institutions have maintained their focus on gold as a diversifier, with purchases reflecting strategic considerations rather than transient opportunities. In China, the pattern of reported monthly increments, typically ranging from under 1 ton to a few tons, illustrated a disciplined approach, prioritizing steady enhancement of reserve composition amid fluctuating valuations. Developments within BRICS have advanced collaborative efforts and financial infrastructure, most prominently through the pilot operation of the unit, a digital settlement instrument partially backed by gold. Structured with 40% weighting in gold and 60% in a basket of member currencies, this blockchain-based mechanism has progressed in targeted applications, facilitating certain cross-border commodity transactions with enhanced efficiency and reduced reliance on external networks. Though operating in early phases, the unit exemplifies the translation of accumulated physical reserves into functional tools for trade settlement, aligning with broader objectives of financial autonomy and stability. Subtler influences have also characterized the year's market environment. Elevated prices, while constraining segments such as jewelry fabrication, did not substantially deter official sector participation, as long-term reserve objectives predominated. Investor activity through physically backed funds and retail channels provided complementary support, offsetting variability in other demand categories. Supply dynamics, including mining output and recycling, navigated constraints without disrupting overall balance, while environmental and regulatory factors in production regions introduced ongoing considerations. On the broader international landscape, these trends have prompted continued examination of reserve policies and monetary frameworks. The sustained prominence of gold demand at high valuations reaffirms its role as a bridging asset across varying economic systems, offering resilience for entities facing external pressures and diversification for established portfolios. Incremental adoption of alternative mechanisms underscores gradual evolution in trade and settlement practices, where tangible backing integrates with technological advancements. As the calendar turns on this December day, China's consistent reserve enhancements, complemented by aligned initiatives across BRICS partners, embody a sustained commitment to fortified and diversified holdings in a landscape marked by uncertainty. Official editions, calibrated against prior records, accumulate toward a repositioning that progressively elevates gold's strategic significance. The maturation of concepts like the unit signals practical progression in multipolar financial arrangements, anchoring value in combined physical and currency components rather than exclusive dependencies. Gold's exceptional performance through 2025, achieving and sustaining record territories, attests to its adaptive utility across periods of transformation. Moving forward, the convergence of institutional preferences, policy orientations, and trade patterns will guide future directions. Persistent central bank engagement maintained at meaningful levels supplies enduring structural support, while developing settlement innovations may extend operational scope. In times of structural transition, gold endures as a core element of prudent reserve architecture, promoting balance and continuity while illuminating the merits of deliberate asset-backed approaches to navigating global economic interdependencies. The year's accomplishments, assessed comprehensively, emphasize not only valuation milestones, but the deepening integration of gold into frameworks designed for long-term equilibrium and resilience.